Hello everyone, and welcome back to the Web3 Daily. The feeling I'm getting from the market today is that classic calm before the storm. Have you noticed it too? Bitcoin is in a real tug of war right around the $116,000 mark, and Ethereum is just drawing a flat line at $4,500. It can't seem to push up, but it's not really dropping either. And to be honest, when I see a chart like this, my first reaction isn't relief. It's actually a bit of anxiety. Because we all know that, while things look calm on the surface, the undercurrents are swirling. Trading volume has clearly dried up, which means most of the capital is on the sidelines, waiting. Everyone is waiting for a signal, one that would dictate the market's short-term direction. And what is that signal? Well, that's the main event we're talking about today. The Federal Reserve's interest rate decision. At a critical moment like this, the Fear and Greed Index is still pinned way up at 78 in the extreme greed zone. What does that tell you? It shows that sentiment is still incredibly bullish, but traders are acting with extreme caution. The bulls and the bears are like two gunslingers in a standoff, and nobody wants to draw first. So, what does a Fed rate cut actually mean for the crypto space? Does a cut signal it's time to go all in? When I first saw this on the horizon, a question mark popped into my head. Because let's be real, the market has been pricing in this 25 basis point cut for months. It's pretty much a done deal, and that expectation is fully baked into current prices. That's why the real show today isn't the rate cut itself, it's the press conference with Fed Chair Jerome Powell that follows. How he frames this decision, that's what will determine whether the market breaks out to the upside or takes a nosedive. Let me put it this way. If Powell comes out and says this is just a precautionary risk management type of cut, that the economy is still strong, and they're keeping a close eye on inflation, that's a hawkish cut. The market will get that message loud and clear. Don't expect the floodgates of easy money to open up. We could see a brief pop followed by a swift sell-off, maybe even a deep correction. On the other hand, if Powell's tone is soft, if he hints that the economic data is looking a bit weak, and that more policy support might be needed down the road, well, that's a dovish cut. That signal tells Wall Street that a new easing cycle is about to begin. And for risk assets like Bitcoin and Ethereum, that's the best news you could possibly ask for. I looked back at the history books. The rate cut in 2019 didn't really move the needle much. But in 2020, when the Fed unleashed unlimited quantitative easing during the pandemic, it ignited the massive bull run for the entire crypto market. So, what we really need to watch today isn't the number. It's Powell's language, his tone. That's the real alpha, hidden behind the headlines. Alright, now that we've covered the big macro story, let's pivot to the regulatory front, where something just happened that could fundamentally change the industry landscape. You might have seen the headline about Grayscale's fund with Solana, XRP, and Cardano getting the green light to trade. But did you consider the even bigger bullish story hiding right behind it? When I saw this news, my first thought was that the Altcoin ETF era might finally be upon us. Just yesterday, the SEC quietly approved a new rule that allows major exchanges like Nasdaq, the NYSE, and the Cboe to use a generic standard to fast-track the listing of crypto ETFs. What does that actually mean? Let me break it down. Before this, every single new altcoin ETF, say, for Solana or XRP, had to go through its own separate, lengthy approval process, filing a specific document called a 19-4 and waiting for up to 8 long months. It was a painfully slow case-by-case grind. And now, the SEC has essentially built a superhighway for these exchanges. As long as a crypto asset, like Solana, already has a regulated futures product on an exchange like the CME, its spot ETF can now bypass the traffic jam and speed right through the approval process. It's no wonder that Bitwise's CIO, Matt Haugen, came out and said this could trigger an ET-palooza. Grayscale's fund getting approved so quickly is just the first vehicle to get on this new expressway. This single change has effectively removed the biggest procedural roadblock for a potential wave of altcoin ETFs to hit the market. And speaking of regulated futures markets, what do you know? The Wall Street giants are already making their next move. Literally just finished saying that ETFs need a compliant futures market as their foundation. And before the words could even fade, the biggest player in that arena, the CME Group, dropped a bombshell. They announced plans to launch options products based on their Solana and XRP futures, targeting an October 13th start date. When I saw this news, the first phrase that came to mind was, "The pros have arrived." What does this really signify? It means institutional interest in top-tier altcoins has graduated from the should we even buy this phase to the how do we manage our risk and run sophisticated plays phase. Before now, on a platform of CME's caliber, only Bitcoin and Ethereum got this kind of VIP treatment. Now, Solana and XRP are joining that exclusive club. This is so much more than just adding a couple of new trading tickers. It means those fund managers who control billions of dollars can now use the most traditional financial instruments out there to hedge their spot Solana and XRP exposure, or to build out all sorts of complex arbitrage strategies. This dramatically increases the appeal of these two assets in the eyes of institutional investors. More importantly, if you connect this story with the last one, a clear roadmap emerges for an asset to get a compliant spot ETF in the US. Having a liquid, regulated futures and options market on the CME is practically a prerequisite. By paving this road, the CME is essentially giving the future Solana and XRP spot ETFs the most critical assist they could ask for. Alright, after seeing the moves from the traditional finance giants, let's turn our focus back inside the crypto world itself and take a look at the new blueprint Ethereum's visionary Vitalik has just laid out for us. Ethereum's price action has been strong lately, and a lot of people are asking, what's next? At the recent EDCON conference, Vitalik gave us a pretty clear answer. He unveiled Ethereum's latest technical roadmap, and there are a few points in there that I think are absolutely critical to understand. First, in the short term, they are going to continue optimizing the layer 1 itself by directly increasing the gas limit. This means a real tangible boost in the mainnet's transaction capacity and hopefully even lower fees. But the part of this roadmap that really stood out to me, the part that was a bit of a surprise, was the unprecedented priority Vitalik is now placing on privacy. The Ethereum Foundation has even spun up a dedicated team called PSE to push for end-to-end privacy features with the goal of enabling things like private transfers, private voting, and even confidential DeFi. What does this signal? It signals that Ethereum is no longer content with just being the world computer. It now aims to be a safe harbor that protects user privacy. Looking at the medium to long term, Vitalik's core objective is to solve the fragmentation problem we see across the layer 2 ecosystem today. He wants users to feel like they're interacting with one single unified system when moving between L2s, not just hopping from one isolated island to another. And finally, he touched on an even longer-term vision he calls Lean Ethereum, which includes implementing quantum-resistant cryptography to ensure the network's security for decades to come. All in all, this roadmap delivers both practical short-term upgrades and an ambitious long-term vision, giving the market a serious dose of confidence. If Vitalik's blueprint represents the internal growth of the Web3 world, then this next story perfectly illustrates how the crypto industry is breaking out and converging with the outside world. Have you ever considered that Bitcoin mining and the AI revolution, two things that seem worlds apart, would one day find a powerful intersection? Chip behemoths Nvidia just announced a massive $683 million investment in a UK-based AI infrastructure company called Nscale. At this point, you might be thinking, what does that have to do with crypto? Well, everything. Because Nscale's previous incarnation was a crypto mining company called EDCON Energy. The first time I noticed this trend, I knew it was going to be big. Just think about it. What are the top-tier mining companies masters of? Securing cheap power contracts, building out enormous high-density data centers, and managing tens of thousands of GPUs with extreme efficiency. That is the exact playbook for building the infrastructure that AI desperately needs. Over the past year, we've seen plenty of miners quietly begin to pivot, converting their facilities into AI compute centers. But it's largely been a narrative within our own crypto circle. Now the game has completely changed. Who is Nvidia? They are the arms dealer in the global AI arms race. For them to come in and put their own money into a company that grew out of a crypto miner is the ultimate stamp of approval. It's Nvidia telling the entire world that the infrastructure and operational expertise built by the crypto mining industry has become a critical component of AI's future. This is no longer just a theory. It's a massive, validated opportunity staring us right in the face. Of course, for any industry to mature and break into the mainstream, it ultimately needs a clear regulatory framework. And in the United States, this final battle over the rules of the road seems to have reached a critical juncture. What has always been the biggest headache for crypto in the US? It's not a lack of technology or shortage of capital, it's the suffocating regulatory uncertainty, especially that endless turf war between the SEC and the CFTC. agency claims everything besides Bitcoin is a security, while the other sees many top assets as commodities, leaving every project and exchange walking on eggshells. I get the sense that the US Congress is starting to feel the pressure. They're watching Europe implement its MiCA framework. They see places like Hong Kong and Singapore actively legislating to become the financial hubs of the Web3 world. And meanwhile, back home, the top regulators are still fighting over who's in charge, forcing innovation and capital overseas. So now, lawmakers in the House are making an all-out push to pass a comprehensive crypto market structure bill, something like a successor to the much-discussed FITO1 Act. Before the current congressional session ends, the core goal of a bill like this is simple: draw a clear line in the sand. It would finally define which digital assets fall under the CFTC's jurisdiction as commodities and which fall under the SEC as securities, providing a clear rulebook for exchanges, brokers, and stablecoin issuers. If this legislation passes, it would be a landmark event in the history of US crypto regulation. It would mean the end of the chaotic era of regulation by enforcement and the beginning of a new phase where there are actual laws to follow. For the long-term health and growth of the entire industry, this is undoubtedly a massive potential catalyst. Just as the US remains gridlocked in arguments over the rules on the other side of the planet, in Switzerland, the giants of traditional banking have quietly achieved something monumental. We often get fixated on Bitcoin's price, or which new project just did 100x, but sometimes the truly game-changing events happen far from the spotlight. Recently, a group of mainstream Swiss banks, including Zürcher Kantonalbank, working on the 6th digital exchange, successfully completed the world's first legally binding interbank payment using wholesale central bank digital currency. To be honest, I was more excited reading this headline than seeing Bitcoin jump $1,000. Why? Because this strikes at the very heart of the financial system: clearing and settlement. This transaction wasn't some casual experiment in a sandbox. Every step had the same legal finality as a payment made through the traditional Swiss interbank clearing system. Here's what they did. They took a bond and tokenized it, then used tokenized Swiss francs to pay for it on the very same distributed ledger. It's a process called atomic settlement, where the asset and the cash change hands at the exact same instant. This virtually eliminates the counterparty risk that plagues traditional finance and dramatically boosts efficiency. This isn't one of our familiar crypto hype stories. This is the first string army of traditional banking using our core technology to upgrade their own heart. The long-term significance of this is arguably far greater than any single altcoin ETF approval. It provides a real-world glimpse into a future where all stocks, bonds, and real estate could be tokenized and traded on a more transparent and efficient system. The bankers in Switzerland just showed us what that future looks like. Alright, that's a wrap for today's Web3 Daily. If you found this helpful, do me a favor and hit that like button to show your support. Every day, we're digging through the noise to bring you the most critical, actionable insights in the Web3 world. The information closest to the opportunities. We hope that by breaking down these curated stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped our exclusive registration links for all the major exchanges down in the description below. These are special deals we've arranged for our community with high commission rebates to help you save a bit on costs along the way. Let's all commit to staying rational, moving forward steadily, and building our wealth patiently here in the Web3 space. May everyone's crypto portfolio see steady growth. We'll see you tomorrow